What happens to your pension the day it starts earning more than you put into it? There's a point, and most people never notice when they pass it, where your contributions are outstripped by pure investment growth. Your money goes to work harder than you do. We called it the tipping point in an earlier episode, and clearly it hit a nerve, because today we're back on it, only this time it's even more personal. My co-host Chris has crossed 100 grand in his pensions. So we're going to get into how he got there and why, what his portfolio should look like now he's passed that line, and the question that sneaks up on everyone as their savings grow: charges. Because once your pot is big enough, a small percentage charge is real money, and you might be handing over more than you need to. Navi Money is proud to partner with Coinbase. If you're thinking about getting into crypto, but not sure where to start, consider Coinbase. In just a few taps, you could buy, sell, and hold Bitcoin, Ethereum, and a range of other popular crypto assets, all from right here in the UK. Coinbase is registered with the FCA in the UK, and with world-class security, you can invest with confidence. Whether you're brand new or already building your portfolio, Coinbase gives you simple tools for crypto investing. Join millions already using Coinbase. Download the app today and start your crypto journey. Find out more in the summary. Remember, don't invest unless you're prepared to lose all the money you invest. This is a high-risk investment, and you should not expect to be protected if something goes wrong. This is not investment advice, and it is not a recommendation to buy or sell any particular digital asset. Now, let's get right into it. Chris, hello, how are you doing?
Hi, Ed. Doing well, thanks.
Obviously, because you've hit your big old tipping point. Fantastic news.
Sliding downhill in a good way from this point, picking up speed, hopefully.
So this is what we're going to get into today. We're going to look back at what the tipping point was. We did that in a previous episode, which you can catch on the main channel. But you've hit your tipping point. We're then going to look at what you're going to do next with your portfolio. And then we're also going to consider this issue of charges. Chris, you've hit that £100,000 tipping point in your pensions. Where do you go next?
I'm going to turn it to £1 million, Ed.
Right. Okay. Ambitious. I like it. Let's find out how that's going to happen. So let's just pull things back a little bit. Explain to me the tipping point. What is it and how does it work? What's the theory?
So it's attributed to legendary investor Charlie Munger. So his thing was, look, whatever you do, you have to get to your first $100,000, because at that point, the saving and the contribution that you've done into your portfolio to get that will, in theory, be outstripped by the growth, the investment return on the size of that portfolio. So, for example, if you're putting in £6,000 a year into a portfolio at 100 grand, then, and you're investing it in a kind of modest way, you don't have to be investing it in the next big thing, then the portfolio should turn over more than that £6,000 over the course of the year if it performs in a certain direction. In other words, your portfolio starts to work harder than you can. It's adding money to the value of it. And that's when it really starts to pick up speed and snowball and start to build a real large size pot. And the received wisdom is that once you get to that point, your pot size should double every 10 years. Now, there's no guarantee of that, but if you start to think about that compounding impact, that's immensely powerful for people who are thinking with a really long-term time horizon. Hence why I'm able to make that bold statement about £1 million, Ed. I'm hoping that will work.
Yes. So that £1 million figure, Chris, what does your portfolio construction look like to get you there, and how is that kind of that number being reached?
It's pretty basic, Ed. So I've gone away and looked at, I started investing obviously when I started saving into my pension. So I have looked at making sure with the long time horizon that I've got that I am invested in equities. So I'm not in bonds or any of the other things we talked about previously that are slightly less risky. I've decided to invest in companies that I think are going to be able to deliver that return. I broadly spread that across the globe. So my approach is broadly geographical. So I buy different regions, the indices in different regions, cheap tracker funds that buy the top companies in each one of those regions. The idea being to keep a lid on charges, but also to get the advantage of the best performing companies in all those different regions. And then to keep my contributions going with a regular cadence with what's called a sort of pound cost averaging approach. So markets are going to go up and down over that period of time. We know that. I've seen that in the last year. Anyone who's been paying attention to the markets will have seen that. But the idea is that over that long enough time horizon, the line will go up, and there's no guarantees, obviously. Past performance is no indication of future performance, but history would suggest that would be the case, and I'm willing to take that risk. So if I keep drip feeding that money in, then I'll catch when markets are low, and I'll catch when markets are high, and that will come out in the wash in a kind of favorable way for me. So it's just a case of continuing to keep that regular cadence up, diversify in terms of that geographical difference between them all, and make sure that I'm invested primarily in equities at this stage. Now, when I get closer to retirement and that pot gets bigger, I might want to reduce the risk of stock market fluctuations on my portfolio, because as the improvements also can be larger, the losses could be higher as well. So I might want to protect that a bit more. But for now, equities across the whole thing, across the entire geographic spectrum. It's been quite interesting unpacking my approach and what I did a few years ago. So looking at it, I've got way too much of a home bias, they call it. So I'm way too invested in the UK. So I'm looking to rebalance out of that and try and spread across US, Europe, Asia, China specifically, and then obviously maintain the UK thing. And I was thinking back as to why I did that. And the reason I think was I felt like the FTSE was something I could follow every day when I woke up in the morning, and there's always on the news down. This is me sort of 15, 20 years ago when I first started that thing. So now it's got 25 years left. I need to rebalance that and have a more global approach. And I feel more confident in doing that. So that's the plan, just to keep contributing the money, see that growth, that gross growth numbers tick up as the portfolio ticks up. Then hopefully that momentum will start with those returns. And I'm looking at 3 different scenarios. So there's conservative returns, which would be around about 5%. Average returns, which would be about 6.5, 7, and then really strong performance, which would be 8% up. None of those are outlandish. They're assumptions you can make, and from there you can project forward into what a pension pot might look like. So the medium and the strong performance will take me over that £1 million benchmark if keep a lid on charges and consider some other things in the future, like upping my contributions when family finances allow me to do. So yeah, as a plan, I think it can work, but just in turns ahead.
So it's important, these investment growth figures are notional. Obviously, the past performance won't indicate what could happen in the future. These assumptions that we make. And it's also important to remind those of you following along, we don't give out financial advice here. We're just illustrating the issues and how our personal situations work out. Bringing it back to that, the tipping point, though, I think what's really important to stress here, this is why Charlie Munger makes such a big deal out of it, is it's that first 100,000 is the hardest bit of the grind, right? Getting to that point. And that is what's so difficult. So once you reach that point where effectively the growth of your pot is now outstripping your contributions, that's a big win in that kind of long-term process of saving for retirement, isn't it? That's why it's a good news that you've reached that level.
Yeah, I really think you've hit the nail on the head there. I've come on to speak to you about this. I'm really enthused about it. And I'm enthused about money anyway, as we know from our conversations. And speaking to you on this pod and obviously speaking to experts about this stuff with the job that I do has made me more determined about this. But it can be quite soul destroying when you're looking at a tiny pot in your sort of 20s or 30s and you think, oh God, this isn't growing anywhere near to the numbers that people are projecting that you're going to need for retirement. And I hadn't really, even though I knew about it intellectually, I suppose, this idea of compound interest, I hadn't really intuitively understood the power of it. But what I did do was make the decision to be disciplined about it. So it's, listen, I'm just going to hive off a certain amount of money. I'm going to contribute that into my SIP. I've also got a workplace pension, which goes in without me noticing it and is matched by my employer. That's massively important as well. And that forms part of these 2 parts of this portfolio, because I've got my SIP with Hargreaves Lansdown and my workplace pension with Legal and General. And those 2 things are balancing each other out in terms of contributing to that 100,000 figure. Yeah, you end up grinding through, like you said, and just pushing that number up as hard as you can. And actually what that has taught me over these periods of time is that discipline is crucially important. I'm going to take that forward into the next 25 years, because the more disciplined I stay with it, the more likely it is to hit that £1 million target that I've got there. But all of a sudden I've got something to aim at, and it feels like that is going to help me to have a positive retirement. It's important to stress as well that £1 million will need to be inflation adjusted, right? So it's not going to be £1 million worth of purchasing power as it is today. It's probably going to be closer to half of that, but that's still a meaningful size pot that I can use to help myself and my wife in retirement. And I haven't even got on to thinking about what state pension might do with that, and then what my wife's pot might look like at that point. It's not quite, she hasn't been quite as able to save quite as much as I have over that period of time. But you factor all of that in together and you're like, well, actually, this is heading in quite healthy directions. It creates an emphasis and an enthusiasm to keep going and keep that discipline.
This is that one point where I can't compare like for like with you, because my wife Ellen she's a nurse in the NHS, so she's got this really wacky NHS pension where you don't ever see what your pot value is worth. You just get a mad projection of what her income is going to be in retirement kind of thing. It's all very spurious, but I think that's perhaps for another day. I think what's really interesting actually as well, so one point to make actually is once you reach that tipping point, I think, and you've made the point, but I'm going to reinforce it now, is that you shouldn't be taking your foot off the accelerator, right? You got to keep those contributions going, because that's still a really important kind of undercurrent, despite the fact that the growth might now be doing more than the contributions are doing. I think that's really important to stress. The other thing I'd stress is actually, we're talking about in the context of pensions here. We're not talking about ISAs today. What's really important with pensions that I think people perhaps forget, I'm not quite sure, I never get a good sense, is the importance of tax relief in a pension. Now, pensions, when you want to withdraw from a pension, have a whole different set of kind of tax assumptions coming out. And that's, again, something for another day. Because we're talking about money going in now. When money goes in, if you're a basic rate taxpayer, you get 20% tax relief. If you're a higher rate taxpayer, you get 40% tax relief. What that does is it means that you have more capital to grow over a long period of time. So your baseline is stronger with that added tax relief. And that's what makes a pension such a powerful tool for retirement. Now, there is one really interesting caveat here, and this is not something that we've really covered much in the podcast before, but I think it is really important. And I think it's very important for you now, Chris, especially now that your pot is looking on, I won't say larger side, because relative to some people out there, you're doing really well. Salute you for that. But you are now reaching a point where charges become a more interesting problem. Yep. So that is the fees that you pay on your pension. So there's all sorts of different fees that you can end up paying depending on your provider. But the two basic ones for the purpose of this discussion are the fees you'll pay on the funds you hold. So that'll be an ongoing charging fee, effectively, that you get charged every year. Then you typically have a platform fee. Now, Chris, are you going to talk me through exactly what it is that you've got and your charges? I'm interested to hear.
I'm going to do my best. I have to say that it can be quite difficult to nail all of that down. So I've enlisted the help of AI here. So there may be a slight sort of deviation. But what it does is it helps to paint the picture of the value of that and why it's important to try and look at the charges over that period of time, as you rightly pointed out. So based on the cost, so the first decision I've made is that I've got a couple of legacy active managed funds that perform perfectly well, by the way, and have done really well if you look at the projections over that period of time. But the first thing I did was, if I want to rebalance this and just keep that kind of geographical spread and just buy those cheap trackers, then I probably need to move away from these slightly more expensive managed funds. So I've sold a couple of the holdings within those and moved those into trying to make a better geographical split. So we can come on to that maybe later, potentially, about what that looks like. But that means that those charges are around about, for each of those funds, around about the 0.1% mark, essentially. So as cheap as it can go with those kind of things. And then, as you really point out, Hargreaves has a platform charge of 0.35%, I think it is. So that's for holding that money on the platform and for them executing those trades. And also there's a dealing charge, which is nominal, £3 or £4 whenever you move holdings out of a fund. Now, I'm not doing that all the time. So only when I do these kind of rebalancing exercises when that happens. So I swallow that, which is not particularly bad either. And then you've got the Legal & General platform stuff, which is my workplace pension. And that, from what I can see, that's incredibly cheap. So it's a platform fee of 0.25%, so slightly cheaper than the Hargreaves. And the funds that I bought there, which again, these tracker ones, are around that 0.1% mark as well. So it's all adding up to a blended cost of somewhere between 0.4% and 0.5% on a portfolio, which is not amazingly dirt cheap, but it's also not at the expensive end either. And so I had a look at what the impact of that could be on a portfolio, right? So if that 0.4% were to rise to 1% with charges, so if I wasn't on top of it and didn't look at it over that time period, then what I'm getting estimated here is that it would cost me £140,000 in money, right? Because that would go out in charges over that 25-year period. If it went to 1.5% from the 0.4% that I've got now, it would cost me an additional £250,000, Ed. £250,000. So if you're looking at, you're talking early on about, I'm getting excited about having reached 100,000, right? The idea of me not throwing that away, but losing that through not staying on top of this annually, looking at where costs are and charges are and all that kind of thing, and losing £250,000 just through inaction or not paying attention to what I'm in, that feels criminal to me. As well as this discipline of contributing, taking advantage of the benefits of employers contributing, which is a massive part of it. The tax relief stuff you talked about there, it's very tax efficient to save into a pension. The returns, so making sure I'm invested in that equity stuff to get the returns that I think I'll need over that period of time to grow the pot more. Those charges are actually a massive component when you look at it like that. And it's something I'm only really now paying a huge attention to. But luckily, I haven't been too badly stung by that over the period up until now. I've been saving because I ended up sticking it in these cheap trackers anyway, because it was part of the way that I was thinking about it. It's important to check. As you say, I'm not a financial advisor. This isn't financial advice, but being aware of those things and factoring it into your decision making is massively important, because as we've seen, it can have a material effect on what your retirement pot's going to look like.
What is quite important to think about now at this point is, although those kind of platform fees aren't terrible, you are now at a point where even a kind of relatively low percentage figure is going to start costing you. So, the difference between the charges you pay if you've got a £15,000 pension pot and a £100,000 pension pot, even at the same percentage figure of 0.35 or whatever it might be, the cost is much higher for you when you've got a larger amount of money in there, because just the way the percentage works. So what is important to think about when you start getting to this level, and this is for anybody who's probably over about £50,000, although I would urge anybody to do their own sums on it, is to start looking at whether actually a fixed fee platform starts to make more sense. Now, there is one major one, which is a competitor to some of the ones we've named, which is Interactive Investor. Their charging structure is a little bit, I think, perhaps more complicated than it used to be. But yeah, what happens when you move to a fixed fee is suddenly actually the value of your portfolio no longer really matters, and the relative cost comes down the bigger your portfolio gets, and it basically gets cheaper the more you've got in your pension. So I think that's a really interesting thing. I'd say it's worth, in your situation now, Chris, considering and having an eye over. Obviously, again, people got to do their kind of sums on it, and it can be really tricky to do this. I was trying to look up some of these charging figures because back in the day when I used to write about this all the time, I used to be really on top of it, but we used to have to get help from other organizations to unpack all the myriad of fees. And there's so many different platforms and so many different choices and so many different kinds of fees and the way they charge things. And it's a real mess. But I think it is really important to keep in mind, especially in light of what you mentioned there about spending £250,000 in fees. That's wild. That's really wild. That's a lot of money. That's not trifling amounts of cash. So yeah, I think that's really important to keep in mind. With that in your head now, Chris, what are you going to do next?
I think for me, the platforms, I haven't got much of a choice with the legal and general stuff because that's where the workplace pension is set up. And by and large, the charges there seem quite reasonable. On the Hargreaves side, I take your point. The convenience of using Hargreaves, I find using it was really easy, intuitive. My girls are there, that kind of thing. But as you rightly point out, it is something I need to see if I can shop around and look and maybe potentially get a better deal, and whether I can recreate what it is that I'm doing. So I think that's next job, really. My job at the moment now is just to understand what those projections look like, what it is I need to do in the short, medium, and hopefully long term to keep heading towards that £1 million mark, have that in my head. And then it's a case of how's my allocation looking? So I want to make sure I've got a kind of broad geographical split. That's my approach. Everyone has their own approach. So at the moment, I've got about sort of 35% in the US. I've probably got a little bit too high a concentration in the UK. I want to balance that out with Europe a bit, do a bit more in Asia Pacific and in emerging markets, I think, to get a bit more of those, slightly riskier, but some more returns. So there's a little bit of work to be done and selling some of those active funds that charge. And then once all that's done and that started grinding on again, then it's all shop around then. What does that look like? Where can I move it to? And pension transfers are a painful process. Let's be honest about it. They can be quite difficult because paperwork needs to go from one provider to another. So it's not a move and then jump every year job. You need to commit to something for a relatively long period of time. So I need to be absolutely sure. So there's a bit of digging to be done on that. First things first, let's get the portfolio grinding up the way it needs to, and then we can look to hop it over somewhere else that we think is going to provide a better outcome. That half of the portfolio, the other half is, as I said, tied up in that employer thing, and it seems to be going quite well.
The cynic in me might say that's perhaps a feature, not an oversight of some of the products out there.
Making it slightly more complicated, do you think so?
The consumer experience. No, surely not. Companies making it hard for people to leave their services. Never. I think that about wraps up. That's a really interesting look at the tipping point. I'm really keen to hear from people if they've got their own tipping points in their minds, what they're doing with your kind of portfolios, your pensions, how you're managing that, whether you're worried that you're never going to hit it or whether you're over it and you now need to decide what to do next. We're keen to hear from everybody. We also love to hear questions from people they've got, because we want to ask questions to experts in the field, people who are specialists. We are not specialists, we're guys who talk about this, but we want to connect people and have those conversations. So do let us know if you've got any kind of queries. We're super keen to hear them. Do subscribe, follow the channel for more. We're doing all kinds of stuff like this every week. Chris, with that, I'm going to say thank you.
My pleasure. My pleasure.
Thank you, everybody, for tuning in. We shall see you all very soon. Thank you and goodbye.